Alrighty, folks, it is time we look at the important economic indicators, inflation, interest rates, unemployment, that and much, much more. And of course, we're going to do that
Case
with our good
Stiller for
friend
all of your real estate folks.
Case Schiller. For all us real estate folks, we're going to do this with the one and only Mr. Dan Bird. So take it over.
All right. Good morning, good evening, good afternoon, everyone. Thanks for joining. I feel great to be back with Mr. Zuber this week, since I've been flying solo for a couple of weeks now while he's been cruising around Europe. By the way, did you ever have a situation where your boat was stranded?
We did, actually. One of the bridges we couldn't get around, so we actually had to switch.
Yeah, you switch boats, right?
Yep. Yeah,
but the boats are exactly the same, so you're in the same room. It looks exactly the same.
Exactly.
Yeah, that happened to us too. We were there in May, so kind of the opposite end of the year, and there was so much rain that they had to put those gates, the walking track at the top. They had to put the gates down
to do that too.
The bridges.
Yeah,
but it was interesting because the same crew goes over there. It's all exactly the same. The only difference is you got to pack your luggage and unpack them again.
Yep.
But the room and everything is exactly the same, so it's pretty cool.
Good for them. They did a great job. I'm sure it was stressful for them. They did
Viking does a great job. Absolutely. All right, let me share my screen and talk about some of these economic indicators that we haven't really looked at in a while.
Okay.
For anybody that's interested, go to breakpointtrading.net. If you want my newsletter, just click on that box right there, and you can download it. So we're going to go to charts, and we're going to just go down through some of these on this list on the left over here. Economic charts. And I'm going to have some comments on some of these. Okay. So we looked at the dollar on the last video. Let's look at the VIX real quick. The VIX,
oh my goodness.
Look at where it is. It's at 1263.
Yeah.
Way down here. Okay. You can see where the lows were. That's this dash line. It's below those lows. So VIX
not a lot of fear. Not a lot of fear.
There's not a lot of fear. The VIX is a volatility index. It basically measures what the volatility in options are 30 days out.
Right.
So it's a kind of a little bit of a future looking indicator. It's 30 days away. But when it's that low, that means it's very cheap to buy volatility, and premiums are cheap to buy puts, which is sort of what happened down here. You can see the put call ratio. Usually when the put call ratio gets above 0.8 up here, that normally is a bottom. But in this case, it was right as the market was actually zooming higher. And I think the reason for that is because the cost of puts became so cheap that it was very inexpensive to buy insurance on your positions.
Okay.
By buying puts. And I think that's why it went up like that. But right now, that put call ratio is down too. Now, you might think, well, that's great. The put call ratio is down. But actually, when the put call ratio gets too low, that's when the tops occur. So we actually don't want it to get too low. We want it to kind of stay in this mid-range right up here. The other thing about the VIX, by the way, the last time it was this low, you know when that was?
No.
It was 2019.
Oh, wow, really?
Last time it was that low, and almost exactly the same time of year. End of November, beginning of December, 2019. The market gained through the end of January, gained 11% from that low.
All right.
All right. And I mentioned on the last one, we're about 5% away from all-time highs. All right.
Yep.
Now, if you remember what happened right after that, was the pandemic.
I do remember.
Right? So the market crashed right after that.
It did.
So it's nice that it's low. What that means is we probably won't have any big, huge gaps higher. It'll just steadily move higher. And we won't have a lot of gaps lower. We won't have the market crashing either with a VIX this low. It will either just slowly move higher, or it will go sideways and slowly move down until it resets itself. And then buyers will come back in because the VIX is so low. Buyers will come in at the end of the year, and especially the beginning of January. That's just a function of the way the markets work with mutual funds and hedge funds.
Right.
And individual investors in particular, they'll do their tax harvesting at the end of the year. Yeah. Mutual funds do it at the end of October, by the way, which is why the end of October is so volatile. And then in November, they start reinvesting. Mutual funds start reinvesting. And that's exactly when the market started to take off. You can see it right here, actually. Here's November. Right? So here's that low on that Wednesday that I mentioned, the worst day of the year.
Yep.
That's in October. And then starting then the next week and right after that, it took off. So this whole period right here, the last 2 weeks of October, is when mutual funds and some hedge funds need to take their capital gains or losses. They have to do that before October 31st. Individuals have until December 31st.
Right.
But mutual funds have to do it here. And that's the reason that this period often is volatile like that.
Right.
All right. Okay. So stocks above their 50-day moving average way up here. It's at the point right now. You can see back here. This is a point where tops usually occur.
Right.
But not right when it first gets there, which is what's just happened. Okay. So this right here, I mean, this was what, 1, 2, about 3 weeks before this top. So we just started right here. 3 weeks is the end of the year. So we could easily keep going higher.
Okay.
200-day has not got there yet. So in this case, both of them made it up there at nearly the same time. So that was a definite indication that a top was near. But we still have some room to go right now.
Okay.
So, all right. So let's look at Fed rate hikes.
Sure.
So we've looked at this before. We'll look at it again next week because it'll be just before the CPI number. But I'm going to talk about the CPI thing right now. And then I'll look at the CPI chart in a second.
Okay.
So as you can see, the market is, again, right at this resistance level. There was no rate hike last time. So we've gone 2 months now with no hike. Higher for longer. I am going to start counting that from this last rate hike right here.
Okay.
0.25.
Yep.
So if you want to say higher for longer, we're at 2 months going on 3 months so far.
Okay.
But look at, well, copper, of course, is taking off, which is okay. But the other ones, CRB, oil, and gasoline, have all come down in the last month. I think that, and gasoline has come down and kind of gone sideways. So I think that's going to help the CPI number. We'll look at this again next week to see if these have changed much.
Okay.
Just before it comes out on the 12th, by the way. But I think that CPI will probably come in even, possibly a little bit lower.
Okay.
But not by much.
Okay.
And let me show you what that week looks like. So here's where we are right now. The next week is kind of ho-hum, moving sideways. Then CPI is on the 12th, which happens to be the same day that the Fed meeting starts. And then the Fed announces whether they're going to hike again the very next day.
Right.
And remember, we have a jobs number this Friday.
Yes.
Which we'll talk about that in a minute. All right, so there's CPI right there. So remember that on the 12th, just before the Fed rate hike meeting.
Okay.
So if we go back and look at CPI itself, which is right here. Here's the 12-month window. This is, see this gap right here? That's the one that dropped off last month. And look at what CPI did last month. Went from 3.7 to 3.2.
Okay.
All right. Part of that is because of this big gap right here. Because remember, when a new one is added, the previous one gets dropped off. And it also was partially because of this. Last month, you can see what the commodities were doing. Oil dropped dramatically. Gasoline dropped dramatically. CRB dropped. Right now, they're kind of dropped a little bit and maybe going sideways. They didn't have as much a dramatic of a drop this month as they did last month. Okay. But look at what the next one that drops off. It's not as big as the last month. Right?
Yep.
So when this next one drops off, it's not going to have as much of an effect on CPI. So right now we're at 3.2. I think will be even maybe 3.2, maybe 3.1, something like that.
All right.
Because of those things.
Hmm.
So that's the December CPI. What are your thoughts on that, on CPI? You have any?
I actually think I'm going to call it 3.0 because I think
that's possible.
Yeah, I think shelter is going to start to show its rollover.
True,
So
that's true.
I'll call 3.
3.0. I think that's certainly in the range. So this is before the next Fed meeting, and we got the jobs number to look at too. So I think it's going to be enough for the Fed to say we're going to continue to pause.
Oh, the Fed's done. Choose the Fed's done. Done.
Let me posit this thought.
Okay, sure.
Look at the next one.
Mm-hmm.
This will be the January CPI.
Yep.
Look at how small that is. Right? And if these commodities start to spike higher again, if we don't know that yet until next month, so we'll look at it again at that point. But just this little one right here that's going to drop off, I think CPI is not going to go below 3.0. I think it may come back to 3.2. It might even be higher than 3.2 in January.
Could be.
Because of those things. And if that happens, there is a potential the Fed will hike one more time.
Nah, I doubt it. Because again, the headline is, I think it'll be core, right? I could definitely see headline popping because of energy or whatnot. But as long as core doesn't pop, I see very little chance. But I'm wrong all the time, so I guess we'll see.
Yeah, we'll see. I mean, I just thought it was interesting how close these, in this.
But then you look at the next month, right? The next
month is huge. So yeah, the February one is going to show a huge decline. And if the Fed does take their last opportunity to hike one more time, and then inflation drops dramatically the next month, they're going to say, we did the right thing. See, it's working.
Yes, they absolutely could happen.
So yeah, that's right. The February one is going to that's the one that might be below 3.
Correct.
February.
Correct.
All right. So let's look at, there's one thing I want to show here, this one here. So I want to talk about this saying about higher for longer. And I wish people would stop saying that. I just don't see where it makes any sense right now.
Okay.
So I showed you the thing before, higher for longer. I showed you 2 months going on 3, right?
Correct.
So if we go back here to 2006, 2007, we were higher for longer for 14 months. We're only 2 months into a 14-month cycle. And that's almost at exactly the same point that we are right now. So what the hell does higher for longer mean? Does it mean more than 14 months? Does it mean 12 months?
Well, I can tell you what it means for me. To me, it means no cuts in 24.
Okay, so if there are no cuts in 24, then you're talking about 16 months.
Correct. It'll be the longest on record. Correct.
Right. Well, the longest actually is, depending on how you want to count this, but back in this area here in the 90s, I mean, the rate got all the way up here. It came back a little bit and then went back up again. It was basically in this range for 15 months, but it was actually higher than that before then. This is almost a 3-year period, right? If you kind of combine all of these together, that's nearly a 3-year period right there that I submit, depending on how you want to define it. And this is why I don't like the term higher for longer. That right there is higher for longer. That's 3 years.
Yeah.
All right.
I guess when I was making that claim is I'd always thought it was 14 months. I didn't know it was 15 months was the longest the Fed held steady. So that's what I was referring to when I said higher for longer.
Right. So while we're on this, I want to mention something. I saw a webinar by Liz Ann Saunders.
Yeah, I like her.
You know who she is, right?
Like yeah.
She's the chief investment officer at Schwab.
Yeah.
And really, really smart. I've used some of her stuff on here before. So she was talking to a couple of the CNBC guys that that I think are idiots. They just basically say the thing that everybody wants to hear, valuations are too high, so the market has to crash.
Right.
Well, that's not really why the market crashes. And they said that to Liz Ann. They talked about this higher for longer. And more importantly, they said there's people talking about rate cuts in the first part of next year. And they said, what do you think about that? And when she answered this, I was like pumping my fist going, yes, Liz Ann, that's exactly what I've been saying.
Wow.
She said, it's crazy to think that the Fed has had the most aggressive rate hikes in history.
Right.
And you can see it right here, how steep this line is, right? Even compared to all of these, this line is steeper than anything and for longer than anything else in history. That it's crazy to think that the Fed would have that aggressive of a rate hike to try to control inflation and then suddenly start cutting. That doesn't make any sense.
I agree.
She said, but what does make a lot of sense is the other mandate that the Fed has. And that is the jobs number. And if they see jobs, and the number she used was 4.5 to 4.7.
Okay.
So if you see unemployment getting to 4.5 to 4.7, she goes, I absolutely think they will cut.
Oh,
not because of inflation, but because of their other mandate.
Correct. Yeah, 4.5 has been my number as well. It's like if unemployment goes from a bottom of 3.4 to 4.2, the Fed's going to go, so what? Who cares? But you start getting to 4.5 and close to 5, they're going to cut. Absolutely.
Right. Yes. And that's what I think is going to happen.
Oh, that's okay.
I think the job, we'll find out this Friday what the jobs number is. So it could be 4 or higher this Friday.
It could. Absolutely could. Yeah.
Right.
Yeah. The number's going to be a little messy because of the strikes that finished, but yeah, we'll see.
Right. So let's look at the 10-year Treasury yield. Look at that.
My gosh. Look at that.
Just continues to drop.
Bill Ackman nailed that trade. Bill Ackman got out at 5%.
Another big drop on Friday.
Yeah. 4.2 now. Crazy.
Yep. 4.2 and dropping fast. I mean, I think it could get down here. The 200-day moving average is at 4.0 roughly. 4.02.
Could you imagine going to 4%? What is that, like 3 weeks or something? 4 weeks? That's wild.
Yeah, well, we went, this is, where are we here? 1, 2, 3. We went from 4.6 to 4.2 in 3 weeks.
Yeah, man.
So 4.2 to 4 is only half of that.
Did you see what happened to mortgage rates? Mortgage rates went from 8.03 to 7.09. They almost went down 100 basis points.
Yeah, and I think that they will continue to drop.
Yep. It's funny. People go to my Twitter feed or X feed, and I put out a note about 3 weeks ago saying I think rates are going to go sub 7 by the end of December, and people lit me up. They're not laughing now.
Yeah, they shouldn't be. I mean, I call this about on the 10-year back here when these lines were crossing. I said this has the potential to get back to the 200-day.
Yeah,
which is at 4%. If we look at the inverted curve, so this is one of the indicators for a recession. You see this one here when it goes back above 0. It was 5 months to a recession here. It was 6 months to a recession here. This is after it goes back above 0.
Right.
Right now it's at still minus 0.34. It was getting there. It looked like it was heading there, but then it reversed in 3 weeks. But now it's starting to go back up again. So it might be heading back up to 0. If it gets there, let's say by end of the year or beginning of January, then I think the clock starts then. We've got about 6 months to a recession.
All right.
If that happens. This is the 10-year Treasury with Fed rates.
Yep.
So the green one is the Fed rates. The red one is the 10-year Treasury, and the blue one is the NASDAQ 100 in the background.
Yep.
And these are recessions back here. And I added in secular bull and bear markets.
Right.
Just so you can see where they are. Interestingly, notice in the secular bear, we had 2 major recessions.
Mm-hmm.
In the secular bull, we had 1 minor recession so far.
Right. Yep.
And in the previous secular bull, we had 1 minor recession. So we may have another recession.
Sure.
But I don't think it's going to last long.
Okay.
So, it'll be similar to that.
Nice. All right.
All right. Case-Shiller. Look at that.
Yeah.
Is that amazing or what?
Yep.
The Case-Shiller was rolling over right here, heading back to this moving average, 21-day moving average right here.
Yep.
Much like it did back here in 2007 before the 2008 crash.
Mm-hmm.
Right? It went right down here and crossed over. This is where I say sell a house when it crosses, then buy a house when it crosses back to the upside. Mm-hmm. Well, it was heading there, but now it's back above all-time highs.
Yes, it is.
How about that? And here's the 30-year mortgage rates is this pink line back here.
Yep.
So the black one is actually this gray one back here is the Fed rate. Mm-hmm. And this is the mortgage rate. So you can kind of see Fed rate and mortgage rate side by side right here.
Got it. Okay.
So the Fed rate, this is where it's going to probably level off up here. And depending on where the 10-year levels, the mortgage rates will level off too. In that range. Mortgage rates are over here. So you follow this line back over here, it's about 7.25, roughly.
Yep.
So it'll be interesting to watch to see, how these things correlate with each other. 30-year fixed rate mortgage. You can see the 33-year midpoint.
Yep.
We are just, slightly above it. We're not dramatically above it. Right. We've been higher than this many, many times before. So in the 10-year treasury below it. So you can kind of parallel the 10-year treasury with mortgage rates right here.
Yep.
See how they kind of work together. It's interesting to me that for the most part, they've been pretty much equal, but the 30-year actually got ahead of the 10-year through this period. So it actually accelerated more than the 10-year did. And I've been waiting to see if that comes back and comes back down and catches back up with the 10-year again.
I mean, the historical spread's been about 180 basis points. We were running above 300 for a long time. I think today, or as of Friday, we're like at 283, something like that.
Right. So that one will be interesting to watch. The price to earnings, that's not that interesting. But one thing that is interesting down here is the high-low charts. And I put this one in the newsletter this week. Okay. So if we look at the S&P high-low charts. So this is a large cap S&P new highs minus new lows. So you take all the new highs, you subtract all the new lows, and that gives you a chart.
Yep. And
you can see that new highs are dramatically higher. Up here is the New York Stock Exchange, same thing, new highs minus new lows. It's black finally. And it's been black for three weeks now. So that means as we're heading, I mean, this is what it should look like. As we're heading higher here, there are a lot more highs than there are lows. Right. But look at the bullish sentiment for the American Association of Individual Investors. Bullish sentiment is getting very, very extended. That means more people think the market is bullish than don't. You can see the red is the bearish sentiment. Fewer and fewer people are thinking bearish. In fact, it's as low or lower than it has been in a really long time. It's not quite, the bullish people aren't quite as high as it's been. It was higher back here, but you'll notice that's also where the top was. There was a high back here, but it was lower than these highs. But that was where the top was. So we're not above 50% yet, but usually when it gets above 50%, that's when you start looking for a top.
Okay.
So this is something that we'll be tracking, and I'll track this in my newsletter as well each week to show where we are. But we're getting, very, very bullish. That doesn't mean the market can't just keep going higher. It can stay bullish for a very long time.
Mm-hmm.
In fact, was I think another comment by Liz Ann Saunders. So the market can get crazy, and then it can get stupid crazy, and then it can get ridiculously crazy, and then it can get outrageously crazy.
Go Liz Ann. Yeah.
So the market can just keep going higher.
Yeah. Very cool. Well, I know each week you and I will be talking about this. Where can people get your newsletter?
So if you go to breakpointtrading.net, the newsletter is right there in the upper right. Click on that, and you get the newsletter. It's free. I publish it by about 1 o'clock on Saturday, 1 o'clock Eastern on Saturdays, and it will be out there after that. And then so the books section on this website is free. You don't need a subscription for that. If you want some books to read, everything else, there is a subscription for a lot of these other things, a lot of things that I've been showing. But it's a great resource. It's actually one that now I could not do without.
Yeah.
Because if I want to know the sentiment of the market and what it's looking like right now, I can click on any of those links and see what the sentiment looks like, and then plan my trades as a result of that.
Very cool. Well, I'm getting feedback from my audience over and over that not only do they look forward to our conversations, but what you put together each week and then the charts is very, very helpful. So breakpointtrading.net, folks, go check it out. Thanks, buddy.
Great. Thank you. Take care.